All right, so we are here again by the grace of God to dive into this. And today we are looking at what we call charts and candlestick patterns, right? So this is lesson 3. And what are we going to get? We will learn about charts, candlestick and chart patterns, and then pipette and pips calculation, right? So lesson 3, session 1, talking about charts. In Forex, we have a lot of charts that we use, all right? We have Renko charts, we have what we call the bar chart, we have the line charts, we have candlestick charts, all right? There are a lot of charts that we use to trade, okay? So if you take one candlestick or two candlestick, they give you candlestick patterns. One, because we have some candlestick patterns that are only one, something like hammer, all right? Something like Doji, they are all one, a single formation. When you add one or more candlestick patterns together, they form what? A chart. So, and the chart help you to know the direction of the market. So when I put a single candlestick there for you to identify, you might not even know whether it's a bullish candlestick or a bearish. But when they are in series, they are in chain, then you can determine. All right. So say charts are graphical representation of historical price and volume data for financial assets, such as Forex, stock, currencies, all right? And then commodities, indices, cryptocurrencies, a lot of them, they all have what? Charts, all right? So they are used to visualize and analyze price trend, patterns, and key levels of support and resistance, as well as demands and supply zones or areas. Okay, so these are some few examples of chart that we have: line chart, bar charts, candlestick charts, Heikin Ashi, Renko charts. These are few that we can even mention, right? So moving forward, line charts, they say they are line charts connect closing prices over a specific period, creating a continuous line that provides a basic overview of price movement. Okay, so this is an example of a line chart. We've seen it a lot of time once we start trading. We have the bar chart. The bar chart displays price information using vertical bars. Okay, so you can see that there will be a bar with a hang on the left and another hang on the right, which represent the open and then the close. All right. So when you look at it, this is how a bar chart look like. Okay, so it's each bar represents the price range during a specific time period, including the open and then the closing prices. Right. The next thing we can talk about is the candlestick chart pattern. And then we say that candlestick charts provide detailed information about price movement and are particularly useful for identifying patterns and market sentiments or market structures. All right. So there's a book by one of the Japanese trader. All right. That book is also on the platform. You can check any of our pin messages on the Telegram channel, and then you can also read about candlestick. He invented the candlestick chart pattern, right? So they consist of candlesticks, which present the high, lows, open, and close prices during specific time interval, right? So this is how a candlestick chart also looks like, right? One connecting the other. It can be the same color. The color doesn't matter. Normally, you have to choose your preference color, all right? You can use the default, that's red and green. Normally, I use blue and then red, sometimes blue and then something like brown. That's what I use. All right, so let's take note of that. The color will not give you money. The only thing that will give you the money is understanding their movement. All right, lesson 2 quickly, where we are going to talk about candlestick and chart pattern. So all the chart that we spoke about, the only thing we are going to talk about is the candlestick charts and then chart pattern. Okay. So just as I said, a combination of candlesticks give you a chart pattern. So just know this is as simple as that. All right. So candlesticks. So what is a candlestick? We say that a candlestick is a behavioral or pictorial representation of a market sentiment or price action within a specific time interval. Say 5 minutes, can be 1 minute. What is happening when you go to 30 minutes, the same thing happening. You can say 1 hour, 4 hours, daily, monthly, all right, time frames, all right. So this is to say how long market open and close, as well as its price action reaction within a specific period during the financial open hours. All right, that's financial market open hours. When you consider the figures below, each one represents a specific time frame, whether 1 minute, 5 minutes, 1 hour, weekly, monthly, it's a specific time frame. Okay, so when you look at this, all right, from A to I, you can see different types of candlestick, and these are all candlesticks that we use to what? Trade. These are all types of candlesticks, and they are either in a single pattern or combination of one or two or even three, all right, patterns to make a specific or meaningful in the market, all right? So, anatomy of a candlestick. So, when you're talking about anatomy, what it simply means that how the candlestick is made of. All right, the open, the close, the high, and then the lows, and then the body as well. This what it all what means. So as we have discussed, the forex market is made up of two strong fighters. That's the bulls and then the bears. Anatomy of a candlestick is a behavior and reaction of a candlestick and how long it takes to complete a specific formation in a given period of time. So even when you take 1 minute and then within 5 minutes, all right, you see a hammer form. The same thing when you take monthly, all right, that hammer you saw, which is 1 minute, in the monthly time frame, when you go there and you see hammer, it means that it took the whole month to complete a hammer formation. So there's something we call fractal nature in forex. What's happening at the top when you come to the lower time frame, the same thing has to happen. Nothing should change. The same thing happens. All right. So with this, we can say that each candlestick consists of its open, the closed body, swing low, that's lower wick, swing high, that's the upper wick. So when you look at this, from A to B, and then we have C to D, the market opens at what? Point C and closes at point D. But before it closed, the market, we can see that it moved to A, which is the swing high, and then it came to B, which is the swing low, before finally closing at the point D. All right. When you are doing interpretation of candlestick, you understand that even what happened in the 15-minute time frame has already happened on the 5-minute time frame. All right. So if you're having bullish engulfing on the 15-minute time frame, what it simply means that market took its time, all right, for the bulls to take over in the 5-minute time frame, and then it has manifested in the higher time frame, which is 15-minute time frame, and you are seeing as bullish engulfing. So it doesn't just happen. Something needs to be happen beneath or below the lower time frame before it can be manifested in the higher time frame. All right. So we have the body, that's the real, what we see normally, the colorful part. All right. That's the body of the candlestick. All right. Candlesticks pattern or candlestick patterns. All right. So what is candlestick pattern? So candlestick patterns are popular tool in technical analysis for analyzing price charts, primarily in financial markets. That stock, forex, cryptocurrency is the same thing. Nothing really changes. So these patterns help traders and investors identify potential trend reversals, trend continuation, and market sentiments. All right. So it's important to note that while candlestick pattern can provide valuable insight, they should be used in conjunction with other tools, all right, to analyze the markets, including risk management. All right. So there are numerous of candlestick. Basically, I use 8 candlestick patterns. And out of the 8, I trade only 3 out of them. So every trade that I pick is based on that 3 candlestick confirmation. All right. Whether I'm buying is based on 3 candlestick confirmation. Whether I'm selling is based on 3 candlestick confirmation. So you understand why it is 8, but I use what? 3. Let's move on. So we have the Doji, which comprises of dragonfly and then the gravestone Doji. That's the only candlestick I use. We have classic Doji, we have 4-side Doji, we have long-legged Doji, a lot of them. But I trade only gravestone and then dragonfly. Right. And then we have the engulfing bars. When you're talking about the engulfing bars, we are talking about the bullish engulfing and then the bearish engulfing. Right. And then we have the hammer, which is the bullish pin bar. All right. And then we have what we call the shooting star, that's the bearish pin bar. All right. So the difference between hammer and the shooting star is that hammer forms at the base of a trend, and then shooting star form on top of a trend. So we can talk about Harami or the inside bar. So we have the bearish and then we have the bullish Harami. Then we have the lock candles. And this is a very special candle that I will treat with you. And then we have the morning and evening stars. All right. And then Malbozo or the dominance candle, which we use normally to know that a specific party has stepped into the market. Right. So moving forward, you can talk about Doji candlestick patterns shortly. All right. So Doji is a single pattern candlestick that occurs when the opening and closing prices are roughly at the same price level, resulting in a small or non-existent body. It signifies market indecision and can suggest potential reversal in some cases. So a doji candlestick may appear in a bullish or bearish form. There are 5 basic types of doji in the market, which include the classic doji, long-legged. We have the 4-price doji, dragonfly, and gravestone doji. So during strategy development, our focus will only be on dragonfly and gravestone, just as I mentioned earlier. All right, so we will forget about the classic doji is a doji that the opening and closing price are virtually the same, creating a very small or non-existent body. It signifies indecision in the market, suggesting that neither the buyers nor sellers has control during the trading session. So this is how you see the classic doji. All right. So we have the long-legged, and we said that long-legged doji has long upper and lower wick, indicating that there was significant price volatility during the session. This suggests that while there was indecision, both buyers and sellers had strong influence during the trading period. So this is how you can also see this very long, but the price closed in between them, and you don't even know how to start from. So you just need a confirmation before you can actually trade such markets as well. So we have the 4-price doji. So this is extremely rare pattern where the opening, closing, high, and low price are the same. They represent a state of maximum market indecision. So with this, you need not to trade at all. And especially, you can find this kind of dojis when a specific currencies, the country is having holidays on the bank. Okay, so let's say they are very, very short. It's like there's no movement at all in that particular assets, right? So something like this, almost all the 4 sides are the same, right? So dragonfly candlestick patterns, all right? So we say that dragonfly pattern, this has a long lower shadow with little to no upper shadow, all right? So what it simply means that there might not be any upper wick, all right? It forms when the opening and closing price are at very near to the session's high. Okay, they are very near to the sessions, and that's where it open, market can go as lower as possible, but I'll still come back to close at where it's almost open, right? So a dragonfly doji is considered bullish and may indicate potential reversals to the upside when formed at the base of a downtrend. So this is how it also looks like. It can appear in any of the form, either bearish or bullish. What matters is that you are getting the picture at the end of the day. All right. And then we have the gravestone doji, my favorite trading candlestick pattern. All right. So this we say that is the opposite of the dragonfly doji. It has a long upper shadow with little to no lower shadow, forming when the opening and closing price are relatively near to the session's low. A gravestone doji is considered bearish and may suggest potential reversals to the downside. It's more significant when formed at the end of an uptrend, you understand? When formed into a resistance or when formed into a supply area or zone, it's very, very much significant, right? So engulfing bars, talking about the bullish and then the bearish engulfing, all right? These are popular and significant candlesticks used in the technical analysis to signify potential reversals in price trend. They are a 2 candlestick pattern. This pattern occurs when one candlestick completely engulfs or swallows or close above for bullish and close below for bearish. The previous candles open, and they can provide valuable insight into market sentiment and potential change in direction. There are 2 types of engulfing bar, which are the bullish and then the bearish candlestick pattern. So talking about the bullish quickly, we can say that this pattern forms at the end of a downtrend, which in many cases signifies or signals a potential reversal to the upside. It consists of 2 candles. The first candle closes bearish, and it is a must that the first candle should close bearish. And then the second candle is bullish candlestick that completely engulfs or swallows the first candle. The bullish engulfing pattern suggests that buyers have overwhelmed sellers, indicating a shift from bearish sentiment to the bullish sentiment. This may indicate a strong buying signal when formed at the end of a downtrend. So the market will open here and close bearish, and then the next candle will open quickly and engulfs or close above the opening of the previous candle. All right, so this is how bullish engulfing candle looks like. Okay, so the next one is the bearish engulfing, which is the opposite of the bullish engulfing bar. Okay, so that one will form, and the first candle has to be a bullish candlestick, and then the second one will close below the open of the previous candle, making it a bearish engulfing candlestick pattern. Very, very powerful candlestick pattern. And then we have the hammer, bullish pin bar candlestick. So hammer candlestick is bullish reversal pattern that is commonly used in technical analysis to signify potential change in direction of a price trend. It is characterized by a single candlestick pattern that has small body and a long lower shadow, resembling a hammer. The hammer pattern typically appears after a downtrend and suggests that selling pressure may be weakening, potentially leading to bullish reversal. So these are the characteristics of a hammer. All right, so you can read about it shortly. All right, it has a small body, it has a long lower shadow. We can also say that it has short upper wick, all right, or no upper wick at all. All right, it's mostly positioned in downtrend. So we cannot say that hammer cannot be found or formed in between a trend, but it only becomes a hammer when it's able to reverse the trend. Okay, so shooting star, this is the opposite of the hammer. So we can say that shooting star is a bearish reversal pattern that appears at the end of an uptrend. It is characterized by a small real body, typically bearish, and a long upper shadow, which is significantly longer than the body of the candle. The pattern suggests that the bulls were in control earlier in the trading session, but lost momentum by the session close. So the features of this include opening price is near to the high of the session, the closing price is near to the low of the session, the upper shadow is considerably longer than the lower shadow, and it's more significant when positioned at the uptrend, hence indicating potential weakness in the uptrend, suggesting that bearish pressure may be building up. So that's also part. So traders often interpret it as a signal to consider when selling or shooting the asset. However, it's more important to confirm the pattern with other technical indicators or chart analysis. So we're talking about the morning star and then the evening star as well. So the morning star and evening star are two important candlestick patterns used in the technical analysis to predict potential reversals in the price of a security or an asset. Both patterns consist of three candlesticks and can be observed on price chart for various time frames. So diving into it, we can see that morning star and evening star patterns are more reliable when they occur after a significant trend movement. So the morning star, you see that these are three candlestick patterns, okay? And it's a bullish reversal pattern, usually formed at the end of a downtrend, consisting of three candlestick, just as I said. The first candle is supposed to be bearish. The second candle can be any candle type, all right? And then the third one must be a bullish candle. So that is how that one too is formed. Okay, so the second one can be any color. That's why the colors are two, blue and red. It can be any color at all. But the third one have to be a bullish candle, all right, to make it a morning star. So the evening star is the opposite of the morning star, all right? So the only difference you can see here is that the first candle has to be a bullish, and then the second candle can be any candlestick at all, whether bullish or bearish. But the third one is a must to be a bearish to make it a valid evening star candlestick formation, all right? So these patterns are more reliable when they occur at a support or resistance level after a prolonged trend. Okay, so these patterns, morning star and evening star, they are very powerful. So what is pips and what is pipette in Forex? How to read a currency pair codes, and then pips value and 8 calculations. All right. So moving forward, we say that a pip stands for percentage in points, and the smallest price movement any exchange rate can make. It measures the amount of change in exchange rate for a currency pair in Forex. Pipette is a unit which is usually expressed in fraction. That's 1/10 of a pip, right? So 1/10 is equal to 1 pipette or fractional pip. Okay, so a pip is calculated from the fourth and the final number after the decimal point, with the exception of Japanese yen-based currencies. Okay, so any currency paired with Japanese yen, you have to calculate to the second decimal point. All right, so pips are the means by which market profit and losses are being quantified or calculated. So a pip is calculated from the fourth and decimal number after the decimal point. So considering this Euro USD figure here, that's 0.9034. So with this, we are saying that the 4 there, which is very, very small, is what we are referring as what? A pipette or unit or fractional pip. The last decimal is what's referred as what? The unit or the fractional pip. It depends on the broker as well. Some broker can even move it up to the 6th decimal point. But you have to know that it is calculated from the 4th decimal point. Right. So, as mentioned earlier, all Japanese yen-based currency pairs are calculated and displayed to only 2 decimal points. So this is how that one to also looks like 159.104. So the 4 there is still the units or the pipette. So when you are calculating, we don't normally consider that one, right? Your focus. So with this, all right, if the 3 move from 3 to 4, we have moved 1 pip, but the 4 after the 3, when it moved from 4 to 5, we have moved 0.1 pip. But when the 3 moved to 4, we have moved what? 1 pip. So, and with this, the Japanese yen-based currency, which is in this case Euro JPY, the 159.10, when the 0 moves to 1, we have moved 1 pip. But when the 4 moves to what? 5, we have moved 0.1 pip. So let's also understand that one as well. So how to read a currency pair codes? All right. So reading a currency pair codes can be very tricky if not studied well. It is a must to know the position of each value in quoting the price on the chart. If you don't know the value, forget about it. All right. So each of the values that we are seeing represent a specific number or decimal point that you need to know. So for instance, referring to the value of 2 points location on the Euro USD chart, that's when a point A is 10114 and then point B is 09101, that's 0.01013. This is the difference or the difference of the distance that has been what covered. If you don't know how to mention this, you cannot even read it as what pips that you have generated. All right. So the distance covered from point A to B is 0.01013. But whether to say it's a pips or pipette, it becomes an issue. So you can use this same scenario to identify how to mention this figure. All right. So the price charts that follow will guide you to read the code very, very well. So when you look at this, all right, this is not a value on the chart. And intentionally make it this way: 1, 2, 3, 4, 5, 6. Okay. So the 6th figure, or the 6, which is the smaller, is what you call the unit or the pipette. You understand? The 5 in this case, which is the 4th decimal point, is what you call the ones. The 4 is what we call the tens. The 3 is the hundreds, and then the 2 is the thousand, and the 1 before the point is the tens of what? Thousands. So when you multiply 1 by 10, you get the next figure. All right, this is half. All right, so it's a unit. So you multiply by 10, you come and get 1. You multiply 1 by 10, you get 10. You multiply 10 by 10, you get 100. 100 by 10, 1,000. 1,000 by 10, tens of thousands. So that's how you have to know. So this figure that we are seeing, 0.0113, when you use the same figure to analyze what we have on the chart, you can now know the position of each one. You can now know the position of it. So comparing the distance covered from point A to point B, which is 0.0113, we can say that the 0 fall under the 1, which is tens of thousands. The next 0 after the point fall under the thousands. The next one fall under the hundreds, and then the next 0 fall under the 10, and then the 1 under the ones, and then the 3 fall under the unit or the pipette. Okay. So when you see this, now we can say that 0.01013 can be read as 101.3 pips. So now how do we do the calculations? This is another also issue. Forex trading is not just buying and selling one currency to another. Before a specific buy or sell button is pressed, you first have to know how much pip you are risking, as well as you will gain. All right. So if you don't know how much you are going to gain, then don't buy, don't sell. If you know how much you are risking, then you should know how much you want to get. If you are risking $1, then what do you want to get in return when it goes in your favor? Either 1.5 or $2 or 3, depending on your strategy. So let's calculate the pips gain in the following currency pairs. Euro USD. So we said that 1.102542 1.09102. Euro JPY giving us 149.271 to 152.234. That's 152.234. All right. With that value, we can say that the euro moved from 1.10254 to 1.09102. Then we can see that the difference is 0.0115. When you look at this, you can automatically say that this value can be read as 115.2 pips. All right. When you put this under that scale that we just read, 1, 2, 3, 4, 5, 6, that's tens of thousand, hundreds, tens, ones, and units. All right. You can arrange them under it like that, which is like this. And then you have your pips generated. Very, very simple. And then for the Euro JPY, moving from 149.271 to 152.234 is 2.963, which can also give us 296.3 pips in return. All right. So that's how you do, and then you do your calculation. So once you subtract it or you add it and you get it, you just convert it to get it. Though we have a website that we use to do all these calculations. So this is the end of the calculations. If you have any question on this, please kindly let me know. Let me know if you have any questions so far on this. Let me know. Thank you very much.